Amarillo by morning, up from San Antonio. Everything that I got is just what I have on. I ain't got a dime, but what I got is mine. I ain't rich, but Lord, I'm free. Fort Worth by Saturday evening to see George Strait is where I'll be. Hello, folks. Welcome to Your Money Radio. I am pumped because tomorrow night I'm going to see King George.
That's right.
King George. My wife really
Strait.
wanted to see him one more time before he truly retired. He's already announced his retirement a few years ago, but he's making a tour, and he's going to be here, and we're going.
Oh, man. Congrats.
So it's going to be awesome.
Yeah, did you get pit tickets?
George Michael? From Wham?
I think he's dead, but
Jitterbug.
No.
Jitterbug.
No. Don't ruin it for me, Don. Don't ruin it. I'm going to make my wife. If my wife watched this show, Don, she'd reach over there and slap you.
No, she'd think
she would.
She would. He knows my wife. He knows it. All right. Folks, listen. Before I begin, I don't want to forget, and I want to wish everybody a very happy Thanksgiving. Be safe. I'll personally be smoking a turkey for 24 hours plus. But we will not be doing Your Money podcast next week to give the Revere staff as well as our illustrious producer, Zach, a break. So no money. Now, we still will be doing the daily market insight videos every night that the market is open, not Thanksgiving, not Thursday, but every other day you will be. But the Thanksgiving week is historically, it's a low volume week. Friday's half day. A lot of the traders start going out of town by Wednesday. It just kind of normally there's not a lot of fireworks. But in case there are, we'll still be monitoring what is going on. So just want to give that forewarning. All right.
Show note.
Now, I've got a trivia question for you.
Okay.
What do the Ontario's Teachers Pension Union, sponsored by BlackRock, those ethical guys, BlackRock, Tom Brady, Shaq, Seth Curry, Bank of America, Wells Fargo, and JPMorgan all have in common? Zach, Don, you probably know this. Don't say anything. Zach?
They all sound like they got a lot of money.
They all got, well, they do, but that is why they got SBF'd.
SBF?
They got SBF'd, yeah. Sam Bankman-Fraud, a.k.a. and formerly affectionately known as SBF. That's his short name, because he's cool. He's, it's like a one name, like Cher, I'm SBF. I think SBF now stands for son of a meet the Fockers. Meet the
Bankman-Fraud.
Yes. There you go. Scam Bankman-Fraud. I like that. Sam. Anyway, all of a sudden you got all these people coming out of the woodwork, and they're being named in these lawsuits because they help pump this thing up.
You're talking about FTX, of course. Sam Bankman-Fried.
And the crypto, and there's some funds, hedge funds, Bitcoin funds that are going around, and they're actually. A couple of them have frozen their crypto redemptions. You can't got to leave them on the exchange now. We're not sure we want you to take them.
Really?
Well, they're not even sure they're cleared. Nobody really knows what's going on. So it's going to be a very interesting next week or two. And why is that important? Because it could affect your money. I mean, last week the market was starting to strengthen, and getting stronger. And you had a couple really choppy down days. And personally, a lot of that, I think, was the crypto crash because people were taking money out of taking money out of stocks and bonds to shore up their crypto margin calls. So anyway, that's what happens when you get really broad diversification. You got to take your good assets and plug up the ones that are going to SBF'd. And so you got to do that. Anyway. So, and by the way, Merrill Lynch and Ed Jones, they're trimming advisors. They're both down about 4 to 6% on their advisor count. But why? Well, because it's all about their profit margin. It's not about you. It's not customer service, how much money they can make on you. And along those same lines, LPL2 advisors, sell us your small accounts, the little guy. Sell us your small accounts so you, the advisor, can focus on your growth. Don't let those little pesky accounts slow down and your goal of getting you rich. Guess what? Here's a newsflash, folks. Those two goals aren't mutually exclusive. You can actually take smaller accounts and still be successful, and you take big accounts. You don't have to discriminate, and you can still get rich. And you can help everybody get rich along with you. That's what we strive to here at the Revere family. But first, we got to give the disclaimer.
Yes.
Folks, Your Money podcast is for your edification and education and sometimes entertainment. It is not meant to be individual investment advice. If you want, seek, or need individual investment advice, reach out to moi, Don, or Michael. We're all registered investment advisors. Or you can seek out your own investment advisor. If you're not happy with your own investment advisor, you can reach out to us for a complimentary portfolio review or kind of look at what you're doing. We'd be happy to do that for you. All right. So enough of that. Enough.
Danny would be happy to give you a careless whisper if you contact him.
A George Michael joke? That's a good one.
Yeah, wow.
Sneak that by.
Don. All right. Now, I posted a lot of these articles on the show notes.
Yes, scroll down in the description. They're in there.
And I don't want to get into the stuff on Edward Jones or Merrill Lynch or how LPL is, well, I was going to say a word, but I never.
Yeah, but
I was going to say not doing the right thing by their clients,
Yeah.
but that's, or the smaller clients. They're fine with the big clients. Or just, Anyway, I'm not going to go into all that, but those articles are posted on there, as well as some financial planning. You can do the 4-year Roth conversion. If you've got an IRA, you can absorb the income over 4 years.
Yeah.
Right. And the estate planning, you need to have that bypass clause. So both you and your wife, or both you and your spouse, both you and your significant other get the bypass. You both get your exemption, estate exemption amount, instead of just having a loving will and everything going to the spouse. That's a booby prize. If you're low enough, if you've got, if you don't have too many assets, that's okay, a loving will. But if you've got a decent amount of assets.
Are you saying loving will or living will?
No, loving will. Loving will. A loving will means everything goes to my spouse. Everything. I'm leaving everything to my spouse. Okay. Now, so I wasn't going to go into this, but now Don slowed me down, so I'm going to have to.
Now you got me going.
That's okay.
Sure.
So folks, everybody, right now you get almost $12 million estate tax free. You don't have to die to give that away. You can do that inter vivos or during your lifetime. Okay. Now, but if you got a loving will, everything goes to the spouse, and when the spouse dies, you only get that 11 million twice. By the way, in 2026, January 1st, it sunsets back down to 5 million adjusted for inflation. Okay. So you either get the 5 million adjusted for inflation once, or you can get it twice for 10, 11, 12 million dollars instead of just 6 million with inflation adjusted. Okay. Because you can have a clause in your will or your living trust, whatever you have, revocable trust, so that you both get, so a trust is set up upon the death of the first spouse so that amount can be set aside and it grows tax-free and it's already out of the estate so that you both get it. But I don't want to just grind this show to a halt, which I think I just did.
No.
If you got complex planning, or even not that complex of planning, I'm very good in estate planning, corporate structure, asset protection, 401ks, all that kind of stuff. We do holistic planning, but it's very boring and it's individualized. So if you need something specific, just reach out to me. You can call us at 855-REAL-WEALTH. Okay, now, so a lot of those articles were done and posted up there, but I don't want to do that because it's very, very boring. What I do want to talk about, which is very important.
Yeah.
And it affects everything you do in your life, from buying food, groceries, gas, inflation, all the way to your investing life. Okay. And that is because I've been getting a lot of questions last week about the Fed and the world reserve currency and interest rates and how the Fed works and what they're going to do. Are they going to stop raising? They're going to, stop beating us up. What's the plan? And I was talking to Michael Ramos. I talked to Michael last night. We had about a 45-minute discussion on the Fed, the mechanics of the Fed, and how that works, which also might grind it to a halt a little bit, the show, because it is pretty technical. But I do want to talk about, so I did come across this article, and it actually is very good. It says, Our Currency, the World's Problem, Part 1. And I'm going to go over this very quickly. I highlighted probably too much, but I'm going to go over the highlighted parts because this is a problem with all the world currency, the world reserve currencies. Before us, it was the British pound.
Yeah.
Before that, people don't know, but it actually, the Spaniards were around for a little while till England bumped them off. And before that, it was the Dutch, right? Mm-hmm. People don't know that during the tulip craze, the tulips crashed and so did the currency. Anyway.
Happens.
So anyway, I'm going to read this very quickly. The Bank of England is bailing out UK pensions. This is current right now. The Bank of Japan uses excessive monetary policy to protect its currency and to cap interest rates. They're literally buying yen to fake the strength of the yen. China encourages its banks to buy stocks. The dollar, the world's currency, meaning world's reserve currency, everything's traded in dollars, is on a tear. Interest rates are surging and the financial world is fracturing. So not going over the whole article. Okay. In Bretton Woods Agreement in 1944, the Bretton Woods is actually in New Hampshire, and they signed a agreement after World War II because after World War II, it was very apparent that we were the new world superpower. And actually after World War I, it was kind of apparent, and England had to step down. They pushed it off after World War I and kind of stalled it. But after World War II, we said, no. We're the new kid on the block. We're the big man. We're king of the mountain.
Sure.
Knock us off.
Yeah.
Okay. Plus, we had to rebuild England, so they didn't really have a choice. So the dollar supplanted the British pound. And this is akin to the global currency concept made popular by George Maynard Keynes. Keynes was the brainchild of the Bankor, which was a supranational currency idea. He thought of this one world currency idea. Guess what? That's been around for hundreds of years. George Maynard Keynes just took the idea and kind of dressed it up and put lipstick on the pig.
Sure.
But anyway,
yeah. So
the terms of the agreement, and under the terms of the agreement, they were trying to remedy one of the abuses that countries use when they do the world reserve currency. They typically commit running continual trade and fiscal deficits. So the pact, what they did is they pegged the dollar to gold so that we couldn't get fiscally irresponsible. Guess what, Zach?
What?
That didn't last very long.
No, unfortunately
That's because
not.
we're talking about politicians. And politicians love to spend money.
The situation is fluid when it comes to politics.
So then they created the London Gold Pool, which was an agreement between all these world's leading nations that they're going to hold us accountable. But that started fraying shortly after 1961. They were trying to fix the price of gold to $35 an ounce. But 7 years later, France said, you know what? They broke ranks. They withdrew from the gold pool and they demanded gold from, they said, here are our dollars, our US dollars we hoarded. Now we want the gold. Open up Fort Knox.
Sure.
Give us the gold, baby. So, and this was based on Volcker's advice to Nixon. Most people don't know. Everybody hails Volcker as the hero for raising interest rates and killing inflation.
Mm-hmm.
But they didn't know that he was the one that told Nixon to go off the gold standard to begin with that created the massive inflation, one of the reasons, right? They wanted a fiat currency that they could print till the cows come home, and it loosens the shackles. They no longer have to be fiscally responsible. So once we went off the gold standard, now the Arab countries knew that now, before we were trading gold for oil, meaning we buy dollars, we took our dollars, bought the barrels of oil. Now we were just trading a bunch of wood chips, flaked together, crushed together with green paint and painting some dead president's head on it and saying, this is what we're trading you, wood chips for gold, for oil, not gold for oil. And they saw that and they said, well, that's fine. We're tripling the price of oil.
Right.
We want more dollars. So all of a sudden you unleashed a lot of inflation. So from that point forward, the dollar was a floating currency and Nixon's essentially annulled the Bretton Woods Agreement. Okay.
Mm-hmm.
By the late 70s, Fair Chairman Volcker raised interest rates from 5.875. So folks, when you think interest rates are high right now at 4 or 5, that actually is kind of the 30-year mean. That's pretty
Yeah.
close. We're actually finally starting to get back to the mean. It's just they took us so low, we got used to the zero interest rates for so long. Anyway, Volcker took us from 5.875 to almost 20%, breaking inflation. Well, essentially crushing demand and killing the economy.
Yes.
So while economically painful, Volcker's actions not only ended the 10-year persistently high inflation, he restored economic stability, but more important, satisfied America's trading partners, because now they're not getting this hyperinflated dollar anymore. It's got some value.
Mm-hmm.
So the floating rate dollar regained its integrity. Okay. Now, this Dr. Triffin in 1960, 11 years before Nixon talked about the suspension of gold, he said there's an inevitable problem with the world reserve currency. And he's actually right. He said the privilege of becoming the world's currency eventually carries heavy penalties. Okay. In his thesis, he said the great paradox, and it's actually called Triffin's paradox now.
Yeah.
He got credit for it. He said essentially when you have a world reserve status, it forces a good percentage of global trade to be in U.S. dollars, almost all of it, really. So for trade and global economies to grow under such a system, the U.S. must supply the world with more U.S. dollars, more and more U.S. dollars. So the United States must consistently run trade deficits, and then it forces us to become a big debtor nation. As foreign nations accumulate and spend dollars through trade, they keep extra U.S. dollars on hand to manage their economies and limit financial shocks. These dollars, known as excess reserves, that's the excess reserves in the banking system, are invested primarily in U.S. denominated investments from CDs, bank deposits, U.S. treasuries, and a bunch of other U.S. financial securities. So it's actually good for us for our markets. As the global economy expanded and more trade occurred, additional dollars were required. It requires foreign dollar reserves to grow and were lent back to the U.S. Okay, so making the world even more dependent on the U.S. dollar, many foreign countries foreign countries and companies issued U.S. dollar denominated debt to better facilitate and take advantage of America's liquid capital markets. Folks, that's key, because what they do is now they're reliant on the dollar. In other words, in a foreign country, they can't print in their own currency and stimulate and try to do monetary manipulation like our Fed, right?
Yes.
Because their currency is pegged to our Fed. So they're desperate. They're relying on whatever the Fed does.
Gotcha.
So now that the Fed is tightening, it's squeezing them in emerging markets in other countries too, not just us. That makes it hard. And if they're fiscally irresponsible, which most countries are, they got too much debt, it really hurts. Now their debt expense, their interest expense on their debt is going up just like ours. Okay. Now, it said the U.S. purchases of imports with dollars lent to her by the same nations that sold the goods. So basically, they're making goods, they're selling it to us, we give them dollars, and then they buy our bonds. It's a circular event, okay? Additionally, the need for foreign countries to hold dollars and invest them in the U.S. results in lower U.S. interest rates until you have inflation, further encouraging domestic consumption and providing relative support. So it sounds like a good system, right? It works until it gets too far gone, okay? For their part, foreign nations benefit from manufacturing shifted away from United States to their own respective countries. As this occurred, increased demand for their products supported by unemployment and income growth, thus raising prosperity to their respective citizens. That's the mantra. That's the whole thing. We make the whole world richer. And that does work, except you need more and more U.S. dollars. You need more and more debt. And for our own protection, for our own national security, we still need manufacturing and our own internal market and manufacturing base. That's me. That's my opinion. That's not in this article. Okay. So he said a win-win or a Ponzi scheme. While it appears the Bretton Woods covenant is a win-win pact, there's a massive cost accruing to everybody involved. The U.S. has too much debt, And as such, it has become increasingly dependent on low interest rates to spur debt-driven consumption and to pay interest and principal on existing debt. Lower than appropriate interest rates led to unproductive debt, meaning people borrow for not a viable, it's not that great of a business plan. And then all of a sudden interest rates rise and now you can't afford it. So you have unproductive, when you have a little bit higher rates, competitive rates, bad deals get weeded out and you only do good deals. It actually is in line with economic reality and supply and demand. When you have too low of interest rates and free money, now bad deals get done along with good deals. There is no differentiation, right? That's the problem. So it said lower than appropriate interest rates led to unproductive debt, as can be seen with the debt outstanding rising much faster than GDP. Okay? In summary, the Triffin's paradox states that with the benefits of a reserve currency also comes with the inevitable tipping point of failure. As we've seen in the current instance, rising interest rates and inflation, the point of failure is closing in on the U.S. and the rest of the world. Part 2, which will be very interesting, I'm going to get that hopefully in a couple weeks. The article will focus on the dollar and Fed monetary policy, which may entail, and what it may entail as the Fed continues to push rates higher. So the second article coming out, the dollar and monetary policy, will actually be maybe a little bit more directly related to investments, but this actually directly relates to investments and what is currently happening right now. Now, I slightly disagree with his philosophy or his paradox. If you remain ethical and you stay fiscally responsible and you don't accrue too much debt, that system of a reserve world currency can work. The problem is you have human behavior and you have politicians and their rotten ethics that actually make it too easy to go borrow money, especially when the Fed takes rates down to incredibly low levels. And all of a sudden you get people borrowing money for any reason under the sun, and you start funding bad deals and things that aren't reasonable when rates rise. And when the rates rise, they all go out of business and you actually cause greater chaos. So anyway, I just wanted to go over that.
Dan, can I
just
ask you a quick question about that?
Yeah,
because
I hope I have a quick
I've been
answer.
looking into that as well. Yeah, I've heard of Triffin's paradox as well, and looked into it. And a big problem in sort of what we're going through right now, that makes sense, is this whole system of, by design, exporting or running a trade deficit, basically exporting manufacturing and labor to the rest of the world in order to transfer those US dollars to keep the system going. Where you run into trouble is basically what we're going through now, of trying to bring back those jobs to the US and bring back manufacturing and supply chains. Then you can't export the dollars and the whole system kind of fails. And that's sort of what we're going through now, right? That's kind of the situation.
Sort of. What he's saying, though, is if you continue, forget about bringing manufacturing back. I agree we're doing that now because we realize that might be a national security issue and we do want some manufacturing base. What he's saying is the way that his theory is, the way that that's set up, you have to borrow, keep exporting, and you'll get more and more debt until you can't meet the debt expense, the interest expense. So even without bringing manufacturing back to the United States, he's saying that system is flawed and it's broken. What I'm saying is it's actually the fact that the humans running it are being unethical and trying to stimulate. In other words, they're trying to manage. They're not letting the economy and supply, demand, natural forces self-regulate. The Fed gets in there and tries to manipulate it too much. And the problem is they stimulate and print and drop interest rates and print a bunch of money and stick it in the system when they're trying to stimulate it and speed it up. The problem is they never pull back and suck money out when it actually starts to initially speed up, so that they do it very smoothly. They actually let it go and get overheated. And that's the problem. They don't do a balancing act where they pull back and pull money out of the system. So what you're saying is, while that theory is out there, I don't think I think if you're fiscally responsible and monetarily responsible, you could have the U.S. be a world reserve currency and still have some manufacturing in the U.S. Some manufacturing in the U.S. doesn't make sense, because if it's just a very simple widget and you've got cheap labor overseas, then yes, it is too hard to overcome the labor costs in the U.S. But when you have more sophisticated products and technology and innovation, and you need very tight quality controls, then I think that even though our cost of employment in the workers is more, our productivity and efficiency is better. So I disagree that they're not mutually exclusive. I think there is a way to have both. I just think that the problem is with the ethics and the management, not the system itself. I mean, we don't have everybody keeps talking about this capital system. We're not a capital system anymore. I mean, you can call it crony capitalism. You can call it part socialism, part capitalism. I mean, I don't want to get into semantics. It doesn't matter what you call it. But when big government gets involved and tries to manage, they're inefficient and they get in the way. That's the problem. I believe you need just enough regulation to protect small business against big business interests, meaning the lobbyist, right? And just enough regulation to protect the environment, and then get out of the way. Get out of the way. And innovation and actually greed is a good thing. Greed will help people innovate and make things for other people that will make our lives better and to keep the economy clean. And the problem is when you get large corporations having too much power, they're writing the bills with their lobbyists, and the Congress is not representing we the people anymore. I'll tell you another thing. The Fed has gotten very much political in the last 10 years. Before they didn't used to be, but now they're putting out stuff about income equality and a living wage and all these other things, and that's not their job. Their job is to protect the currency, period. And then in the last 30 years, they've also added full employment, employment, which by the way is actually, those two actually are inversely correlated a lot of times. So they really should just be trying to protect the currency. But yes, I've heard that argument, Michael. I don't agree with it. I think the problem is the manipulation and trying to manage the economy rather than just trying to be responsible and let the markets kind of manage, self-adjust, if you will. Don, you got any thoughts on it?
No, I focus more on the charts because ultimately they'll show everything that's going on underneath the surface.
And actually, I would disagree with what you said. You said ultimately they'll show. Actually, I think they'll quickly show. I think they'll be one of the leading indicators, and they'll show up on the charts before you get a big decline and before you get in trouble. So I agree with Don, absolutely. All right. So I just wanted to kind of go over that. I know that was a little bit deep.
Did you just say you disagree with me and then you agree with me within 15 seconds?
No, I said I disagree with your use of the word ultimately. I don't think it'll ultimately show up in the charts. I think it'll very quickly, immediately show up in the charts. I think it'll show up.
Well, you're trying to put a time frame on ultimately. You don't know what my time frame is when I say ultimately.
Ultimately, very quickly. All we're saying is it's going to show up pretty quickly, and it's going to give you time to. You may get a nick, but you won't get a cut on the jugular.
Right.
You'll be able to get out of the way, and that's the main thing. Anyway, folks, anybody
ultimately you're correct.
Listen, folks, if you've got any questions on this or you want to talk more about this, Mike and I, Don's a little more chart guy, but Michael and I love to talk about the fundamentals and the economics and the Fed and what they do and what they don't do. And we can talk about federal market open market operations. We can talk about the discount rate, the Fed funds, whatever you want. We can talk about all that. You can't do it on the show because it's extremely boring. It's actually good if you're trying to go to sleep and you want to do some reading. Just go to the Fed's website and start reading some of their reports.
Yes, a little dry for the Friday.
A little bit dry
That's
for a Friday before Thanksgiving. All right, folks. Now I want to get into the markets, okay? And I want to talk about, because the markets have been absolutely just manic depressive, bipolar, whatever you want to call it, just up, down, just these big swings on both sides. It does look like they're starting to get a little bit of legs and firm up, hopefully. But look, during COVID, the last bear market during COVID, you had the Fed come out and say, okay, I'm printing $4 trillion of funny money, and we're going to stick it in the system, and we're going to buy bonds and stock. We're buying everything, and we're putting a floor under this. And you saw just a perfect V bottom. Go back to March 23rd of 2020, and it's just a V bottom off the bottom. That's not doesn't always happen. In fact, that's not really the norm. Normally, when you come off a bear market bottom, you'll get fits and starts, and it'll have 4 or 5, it'll have some false starts off the bottom. Mm-hmm. And you got to have a mathematical way to get in, because you want to be able to get in, participate. But if it rolls over and it turns out to be the third leg down, you don't get caught in another 20% downturn. But if it is the bottom, and you're going to get a 20% pop within a month or two very quickly, it's very easy. I mean, not very easy. That can happen very quickly. And so you want to be able to have a discipline where you might get back in, and if it turns out to be wrong, you lose 1 or 2%, but you don't go down 6 or 8 or 10. Okay? That's very important, and that's hard to do. But my point was, last time during COVID, the Fed came out and said, it's the Powell put. We're going to put a floor under this. We're not letting this go any further. Might have been the Yellen put back then, actually, but we're not letting it go any further. And now they're not saying that. They're not being accommodative. They're being a little tougher, right? In fact, they're just talking about they're still going to raise rates. So that's why it's been, and they're sending mixed signals. So that's why it's a much more difficult market now. So with that, Don, I set the pre-Thanksgiving table for you. Go in there and carve the market bird.
Dan, I would love to do that for you. You're talking about the Fed yesterday morning with Bullard saying putting 7% on the table as a terminal interest rate kind of scared the bejesus out of the market, but it held where it needed to hold. I've got a 60-minute chart up here of the S&P 500. I've been talking about two levels. The shortest term level is the 3950 level, which was the low of the pullback from the prior 3-4 days. And then the 3900 level, which was resistance over here, meaning the market could not get above it in late October. The big gap up on the CPI numbers got us above that 3900. We ran up for 2 days, and then the Bullard scare gap down tried to break back below 3900 and couldn't do it. So that was a win for the bulls, was going down to 3900 and not going any lower. A win for the bears yesterday was a rejection trying to get back above this 3950 level. And we actually gapped open above 3950 this morning, but have since failed. So that level 3950, again, it's we're getting mixed messages from the market. A little bit of a win for the bulls, a little bit of a win for the bears, but ultimately, which way it's making it very clear where the key levels are. That 4007, we've been talking about a big fib level. That fib means Fibonacci for anybody that doesn't know what that is. And the market just historically pauses or pays attention to 61.8, 50, and 38.2 retracements of moves. In this case, the 68.1, 4007 is the move off of the low relative to this third leg down here, 43.25 down to 34.91. We got above 4,007 for about 15, 20 minutes this week and then failed. And actually, it was a little bit longer than that. It was a couple of hours, but it didn't hold it, is the point, and hasn't tested it since then. So we're playing ping pong between 3,900 and 4,000, basically. And what's coming down to meet us, Dan, what do I talk about in every video? What's the key level? What's the level on the indexes that we need to be very aware of, because it's the difference between a healthy market and a risky market? That was a rhetorical, because everybody knows the answer is the 200-day moving average, which is dropping still about 3 points a day. It's all the way down to 40.67. So it could be that we just go sideways into next week. This moving average should be down around 40.50 by the end of next week. 40.50, 40.60. Our high this week was 40.30. We're getting very close to the rubber meeting the road on the S&P 500. On small caps, we keep failing at this day moving average. You can see us playing ping pong above it. One day above, a day below, a day above.
Uh-oh. Might have lost Don.
Did we lose Don?
I think we might have. he's
2 days
frozen stiff. Oh, there he is.
Moving average.
Yep. All right, we can hear you.
Sorry?
Don, can you hear us?
Yeah.
We lost you for just a minute.
Lost me?
There you are. You're back.
Oh, okay. Yeah, the 200-day moving average on small caps, we failed trying to get back above that today, so we're out of our small cap position completely now. On the NASDAQ 100, this 285 level is the equivalent of 3950 on the S&P. The NASDAQ is weak today. Tesla down 2.5%, Amazon down 2%, Google down 1.5%, Apple barely positive. You see we got above this 3950, or sorry, this 285 level today, but couldn't hold above it for more than an hour and failed back below it. So the bottom line is the key levels to watch: 280 on the bottom for the NASDAQ 100, 3,900 on the bottom for the S&P. We break below there, we've got problems. On the upside, we want to break back above 285 and then work toward 290 on the NASDAQ 100. On the S&P, stay above 3950. If we can close today above 3950, it'll be a win for the bulls. On the S&P 500, we've got 3 hours and 45 minutes before we close. 2 hours and 45 minutes before we close. It's 1:15 Eastern time here. We got to get back above 3950. It's a big level, bulls and bears battling it out. Typical bear market action. Anytime something looks strong, the bears come in and with their claws swipe things back down. Anytime things look weak, the bulls come in and gore the bears and bounce us back up to another level, just enough to get everybody excited again, and they start buying, and then the bears come back and swat you. That's why they say bear markets kill both bears and bulls. Bull markets only kill bears because all of the pullbacks are contained, they're reasonable. Bears are the only ones that get killed in bull markets. Bear markets kill both. It's very the swings are intense. The swings are sudden. The bull can come out of nowhere when the bear seemingly was in charge, and vice versa. But 3950 is the key level today, and then 4,000 and this declining 200-day moving average on the S&P. Which is currently at 40.67 and headed down toward price, and that's really where the rubber's going to meet the road. The leading index continues to be the Dow. It has a progress over the last week because money seems to have that was hiding in the Dow, moving a little bit more into semiconductors and solar, a couple of more growth areas. By the way, both of those growth areas are benefiting from government welfare with the CHIPS Act that passed and the CARES Act that passed that threw a bunch of money into green energy. So it's not really surprising when you consider who's paying for the expansion of those two sectors. But those are the two that seem to be outperforming. Plus Apple saying they're going to use one of Taiwan Semiconductor's plants that's under construction in Arizona for their chips. Smart move, considering that takes them away from the Chinese-Taiwan tensions that are going on. And also Warren Buffett bought a stake in Taiwan Center. It was revealed this week. That's what was responsible for the big gap up on Tuesday on TSM. So still a broken chart under its 200-day moving average. But if we look at the semiconductor index, the SOX, serious relative strength over the last 3 weeks, certainly relative to the NASDAQ 100, which can't get back above or stay above the 200, can't even get close to the 200-day moving average. It's battling to stay above the 50 and the 21. But that key 285 area being resistance, we need to certainly stay above 280 on the downside, or we would be going lower across the board. That's my take on the markets, Daniel.
All right. Well, thank you, Don. All right. We've got Michael Ramos. Michael, you're going to talk about, I believe, a few solar stocks, right?
Solar. Yes, sir.
Okay. Well, you acted like I had that wrong.
No, you got it.
Even a blind acorn, I was right.
That's right.
Even a blind squirrel, blind
We are
acorn.
talking about solar.
Blind acorn.
Did you say blind date?
I didn't even catch it at first.
Dan,
God,
Dan,
you guys
you remember Norm Crosby?
Yeah,
The comedian Norm Crosby. What was he famous for?
I don't remember. Norm, no, I don't.
Butchering the English language.
Oh,
you are the Norm Crosby of Revere
you.
Asset Management.
Thank you.
Although Tim used to certainly invent a few words.
Blind acorn.
Like extragenous.
That's a good one.
Even a blind acorn gets a squirrel once in a while.
Yes, no question about it. Especially when they're on a blind date.
All right,
Michael, we'll shut up now.
All right. So solar, very exciting sector. It's actually the leading sector of the market, and has been for a little while. So, thought it would be appropriate to talk about it, as a lot of those charts are looking pretty good, and Revere has a position in the leading stock of the market, which is FSLR. So essentially, there have been a lot of subsidies and legislation passed recently that is benefiting this industry, and the two main things are the Inflation Reduction Act, and last week there was within that there was this a key rooftop solar subsidy that was revised, and the new plans, basically in those plans, they're reducing payments to homeowners that have these solar panels that are selling the electricity back to the grid, but they scrapped a proposed monthly connection fee that was included in an earlier proposal. So on the back of that news, Sunrun was up 27%, NOVA and SPWR were both up 20%. And Sunrun benefited the most because what they do is they install and lease solar panels for residential customers. So, yeah, they really benefit from this new proposal. And going back to the solar group as a whole, FSLR is the leader in that group, and the Inflation Reduction Act is really the catalyst for this stock, and the reason why it's moving and benefiting so much. And basically, what this act does, the IRA, is it offers generous incentives to build up a domestic supply chain for renewables. So in that act, there are tax credits to companies that make everything from wind turbines to EV batteries in the US, as well as bonus tax credits for power plant developers that use these domestically made components. And FSLR is the big winner in this because they're the premier US manufacturer of solar panels for residential and commercial markets. And basically, a problem with the solar industry is that a lot of solar panels and components are made in China, and the US, for national security reasons and to build up this industry, are really trying to move away from this Chinese supply chain and to get this supply chain back home. And to do this, the US basically needs to build this supply chain from scratch. So all these companies like First Solar, Enphase is another one, and what Enphase does is they're a US based manufacturer of these microinverters, which are basically devices that can convert the direct current energy that's produced from the solar panels to an alternating current that can actually be used in your appliances and sent back to the grid. And yeah, so what you need to look for is these solar either components or panels or anything in the renewable space that's based in the US, because the US companies are the ones who are going to benefit from the supply chain coming back home and are going to get the most incentives and and yeah, like the policy is basically rewarding, and the subsidies are going to the U.S. companies. And then another one that had a big move recently that Don was looking at and we were interested in was SHLS. And what SHLS does, and this isn't as straightforward as something like FSLR or Enphase, is it's called the balance of system, and they do everything. They do all the components, equipment, structures, and services necessary for the solar industry for residential and commercial uses. And what that means is they do like the cabling, the racking and mounting, the grid connection, installation, system designs. They do everything. So um, yeah, it's a little harder to, because obviously certain segments of that company can be doing well while others aren't doing so well. So that's a little more complicated to do research on and look into and see if it's something you'd want to invest in. But something very straightforward like Enphase, where they make microinverters, or First Solar, they make panels. That's a little simpler to understand. So I personally would stick to those areas. And then the last one I'll talk about is ARRY, Array. And what they do is they design and manufacture solar tracking and solar racking systems. So they have this cool technology that basically allows you put the solar panels on these racks, and they track the movement of the sun. So they're more efficient, generate more energy, and those are really good for both residential and commercial uses. So you have these big solar farms, and with these array panels, they can move and just track the sun and be efficient all day instead of being in the wrong location. So that's an interesting company as well. So I think those are the top ones in my opinion. You've got First Solar, Enphase, and ARRY.
Well, I could tell you this. You know that solar is hot when you heard my phone ring about 10 minutes ago during the show, 15 minutes ago, the phone rang. It was a solar call. And they have called about twice a day for the last week trying to get me on the phone to try to talk about the free solar panels I get on my house. Because I answered once, now I'm screening. So all this money, this government money going to the solar is pumping up that sector. And it doesn't matter the reason, doesn't matter whether it's government funding, whether it's internal fundamentals. Like Don always says, price is truth. And if the stock's going up, we like it. If the stock's going down, we don't like it. So you got to have rules. We've got buy and sell rules. And solar is probably the hottest sector right. Don, do you think solar's the hottest sector right now? Or do you think there's one or two others?
Solar, yeah, semiconductors have been coming on lately, but solar really is.
Okay. All right. Well,
everybody wants to short oil too, Dan. And I know you're personally offended by that, being a Texan. But oil's pullbacks have been controlled so far, and they continue to hold 50 and 21-day moving averages on pullbacks. Now, the thought for shorting oil is obviously that if the world is going into recession, we're not going to need as much oil. But ultimately, again, price will be the decider. But the European energy policies relying on all this green nonsense when they didn't have a replacement for it, and people are going to freeze this winter, might lead to a little bit of loosening on the reins. But then again, I'm trying to apply logic to a situation. You had Liz Truss, who was the prime minister for about as long as it takes to hard boil an egg. And she said we were going to go back to fracking to try to release it. And then this new guy came in. He said, oh, no fracking, not a chance. So.
Oh, they'll hit their pain threshold. There are other countries.
At some point, maybe they will.
There's a few other countries that have already broken ranks and said, no, we're just going to buy oil from Russia. We don't care. We don't have a replacement. And so we're going to
bring in coal plants back online and bring in nuclear plants back online also.
Oh, man, you're saying that thing didn't work. It didn't have it. All right. Well, enough said.
It's a great idea, just like it's a great idea to buy
it's just early. Yeah, it's just early. It's not ready for prime time yet. They're trying to force it before
they didn't have the replacement ready for it. Yeah.
Right. Well, you got to phase it in. And they're trying to mandate it at a certain timeline, and it's just going to hit a brick wall. It's going to be interesting either way. Well, folks, listen. If you like what you heard, please tell a friend, tell a neighbor. Just send them to revereasset.com. In the upper right-hand corner, there's a subscribe button. They can click on that, and they can put their name and email address in there, and we won't spam them or reach out to them in any way. It's up to them to reach out to us if they want a complimentary portfolio review or just have questions and want this podcast will be directly put in their inbox, normally every Saturday morning when it's sent out. However, if you go to Revere Asset on YouTube, just type in Revere Asset, and you hit subscribe on our YouTube channel, then as soon as Zach, our illustrious producer who I was bragging on a while ago.
Thank you.
By the way, remind me afterward, I got a new client for you.
Oh, great.
That needs to do a podcast. I lost my train of thought now. I shouldn't have said anything.
The outro. We're almost there.
Where was I, though? If you sign up for YouTube, it will be as soon as you post this show, which right now it's about 12:28 Central Time. So maybe in an hour, this show is already on YouTube. You'll get it even before the market closes on Friday, right? Otherwise, it'll just come in our inbox on Saturday morning. It's up to you. But you also, if you sign up, you get our daily market insight video where we actually go over a short 10, 15-minute video where we go over the market internals, the market stats, and what we're actually doing at Revere. We're the most transparent advisor that I know of. And folks, I promise you, if you watch Don's videos 2 to 3 nights a week for 3 months, you will know more than the guy at Ed Jones or Merrill Lynch.
And it's free.
Because those guys, most of them are brokers and they're salesmen. They're not market tacticians, whatever you want to call it. And Don is right there in the trenches. And we're actually showing you what we're doing. We got a whole stock nerd community. Hell, if we don't get out Don, if your daily market insight video isn't out by like 7:30, 8 o'clock, I'm getting like texts like, where's my fix? Hey, where's the thing? So we've got everything all the way from clients that were from the old brokerage houses, the pie chart set it, forget it, that were going down 30% every couple of years, and we're tired of that. Mm-hmm. And they're on board with us and they love it now. And then we've got all the way to active market participants that are traders that trade a little bit on their own and then let us manage the majority of it or a big chunk of it. And we've got both of those. So like I said, it's very interesting. And if you want to learn what we do, you can just sign up risk-free. We're not going to reach out to you. We're not going to, it's up to you to reach out to us. So you can just sign up on that sign up sheet. You can also call us old school at 855-REAL-WEALTH, and you can email us dan@revereasset.com, don@revereasset.com, or Michael at revereasset.com, and even Ted at revereasset.com, and we will be happy to answer all of your questions. Remember, folks, no show next week. Have a happy Thanksgiving. I'm glad the acorn got the squirrel. The blind acorn got the squirrel. And we'll talk to you. We'll talk to you. Oh, yeehaw, George Strait, baby. And I had to do that for you.
Yeah.
And we will talk to you in 2 weeks on your money.
And I'm never gonna dance again. Guilty feet have got no rhythm. Because remember, it's not how much you make in the market; it's how much you keep.
We got to edit that part out.